Hello, this is Mike Swanson of WallStreetWinner.com. Thanks for joining us. It's June the 1st, right after the market closed. The market is up today. And I thought I'd do a live stock market session with Dave for the month of June and see what he is looking at this month. What is he expecting out of the financial markets, the commodity markets? And what's this summer going to be like? So what are your thoughts on what are you looking for this month?
Well, I really think actually we're in like this blow off in the stock market now. I know I have been very conservative the last couple of years, and I'll get more into how I'm trading it right now at the moment, because I'm actually not totally bearish. I'm not totally short. I'm not totally in cash. I have a strategic way of kind of playing all this stuff at the moment. And I'm sorry, I'm just moving my camera here. But yeah. But sorry, that's just some stupid thing on my computer. Anyhow, so I'm really conservative, but I still have some long positions. But I really think when I see the way the Nasdaq is trading and the way that things are trading, that we could be seeing a classic blow off like happened in 1987, like happened in 1998 on a lesser degree, and 1929, where we're seeing a blow off into the summer, and then one of these classic fall crashes. Especially you get the Fed probably going to raise rates again, and I don't think any of these things are going to happen that the market is priced in. I don't think these tax cuts are. I think nothing's happening. I think excuse my language. I think it's still bullshit. So I don't think anything's going to happen on the political front. There's no big boom happening. And if you go read about 1929 and to a lesser extent 87, it's really interesting because you'll read that the economy was actually slowing down and doing poorly in the spring and summer. But what is happening is the speculative fever kind of took over in the stock market, and the market kept going straight up during that time. And I kind of think that's what's going on right now. And the market is getting thinner and thinner. If you look at this percentage of stocks trading over their moving averages, et cetera, it's really not going up on this rally. And again, it's being more focused in the Facebooks and Amazons and FANG stocks and those handful of tech stocks. The casino companies are doing well right now because it looks like Macau is turned around in the short term in China. So anyhow, there's a few sectors here and there. But for the most part, I think I see it like when I look at, for example, like the apps on my phone, and I'm looking at these stocks here. It's kind of like I see a lot of red in some of the stocks that I'm short or just in general in stocks period that I watch. Because I think it's just the market's getting thinner and thinner, and the rallies in a handful of stocks.
Well, what I'm doing is I do have core investments in some sectors I really like, and people probably can guess what they are. But most of my money at the moment is actually in cash. And one thing I'm doing is, I think you're right. I mean, I don't think the stock market's in the verge of an imminent decline this month, not in June. And each month I like to reevaluate things. But one thing I'm doing, and I was doing this last year, but I'm doing more of it, is I'm doing options trades where I'm selling options that I'm looking to make money when they expire. Because even though the market has an upward bias today and for the year, I can find some stuff I feel comfortable selling options in where the volatility I think is going to be lower than what the people buying the options think. The market really isn't surging and going crazy, month by month. It's kind of slowly drifting up, and it's also not collapsing either, like 10% over a couple of weeks. I think we are in a low volatility environment. I do think that's going to change before the year's over, but I don't think it's going to change in June. So I'm kind of trying to sell options to profit from low volatility in the stuff I'm selling, basically. I don't really feel like buying, I'll put it this way. Back in November, I bought stuff that I thought could be potential investments in bank stocks, for instance. And then I sold them a couple months ago because I just don't have the faith because that they're going to go up for years. So maybe the market for a couple months from here, but I don't think it's going to go up for years. And in that scenario, I don't really feel like investing to hold. So I'm more interested in trying to trade. I'm wondering, by selling options a little bit. So I'm curious, what are you doing?
Well, see, this is kind of what I'm doing. I have this approach right now where I'm telling people who are really conservative, what I would do is I would actually almost be all in cash because the market is a total bubble. It's totally overvalued. And I don't really believe in this crap that these central banks can hold it up forever. I think they've been way more successful than anyone has thought. And even the bulls did not think this. Like, I dare you to tell me in 2010, one person who thought the S&P was going to be 2,400 back then. Like, no one predicted this. It's just what's happened now is that it just became self-enforcing, where they have been successful in first rescuing the market back in 2008 and 9. And then they have been successful in recreating another stock market bubble. And so now everyone believes it. And 2020 is hindsight. So it's just like everyone now believes that they can do no wrong, but no one really believed this 5, 6, 7, 8 years ago. Right? So I do believe it's a bubble. And the thing is, your best gains happen off these kind of depressed lows. Like, let me give you an example. If you go back and look at the S&P, I'll get the chart up in a second here. If you go back and look at the S&P, okay, this is let's get the S&P. This is the S&P here. You can see this big kind of breakout today.
Yeah.
Yeah, but and by the way, this is kind of why I think we're going to blow off now into the summer, because it's not like I'll show you a couple charts here. It's not like 2015 now, where if you see 2015, you can see it was actually trending lower all the way through May into the summer, and now we've kind of broken out. So now this is why I think we might do one of these blow-offs into the summer, right? And then kind of really decline into the fall. But sorry, 1 second. Just going further back here. So we can see this here. Like, no one thought that this was going to happen back here. But this is where I'm showing you why you should be in cash. Okay, let's say you got in cash early back in 25, 26. You missed this move from 1,200 to 1,500. You missed the last 20, 30%. But you were able to buy the market and individual stocks even way cheaper during the crash. And look at here. In that first year of the rally, the market goes from 666 to over 1,200. It goes up like 80% in 1 year. Well, even ever as excited as people are now, in the last 3 years, since 2014, the market's up 22%. So do you want to make 80% in a year, or do you want to make 22% in 3 years? But what happens is, because the market's been going up for so long, people get sucked into being bullish on it, et cetera, et cetera. So what I think is going on is we're in this kind of blow-off phase, and you have to accept yourself. There's this old saying, it's a funny saying, and what it says is there's only two kind of people in bubbles. People who look stupid before the bubble ends, or people who look stupid after the bubble ends. And I've been caught in markets where I got sucked into the bubble when I was younger. I don't want to do that anymore. So I rather just sit on the sidelines. You're talking about trades and your options. I'm doing trades. Like, I have 3 or 4 stocks, not gold related. Actually, most of them are technology companies, but they're beat up companies that I'm looking for a turnaround. And actually, I'll give you one of them, because just so you know, I don't recommend buying this stock now because we bought it cheaper. Sorry, VG. It's a little, you can see it in the chart here. This thing was $70 or something, right? But we bought this at around $3.80 a share when it looked like it was breaking out, and it's $5.15 now. We sold some in the last few days, and I have a stop loss. I'm putting on at about $4.80 to $5. But this is the kind of thing I'm buying, and boom, we made a quick 20, 30% in a few weeks in the newsletter, and that's the kind of thing I want to buy. So I have a handful of companies like this. I'm telling conservative people, be in cash. Some of the smaller gold stocks, because they're cheap, they probably wouldn't be affected by a big decline in the stock market, because probably gold's going to go up if there is a big decline in the stock market. have these turnaround plays, but you got to hedge. Even though you might lose a bit of money in the hedges over the next few months, you have to own some bear ETFs, maybe own some put options on select companies that you think can fall, et cetera, et cetera. So that's like kind of my two philosophies now is number one, if you're really conservative, own a couple gold stocks, be in cash because you can take advantage of the market when it does fall. And I'm going to show you this in a second. A big investor has just done kind of this philosophy. And then number two, if you are going to play, if you are going to have little trades, you got to be hedged. And I can do some things that other people don't. Like I have access to all the years I used to travel and speak. I do private placements. I do IPOs. So, but when I do those, I also want to be hedged, right? Because you got an IPO, this thing, if the market crashes, might not ever trade. So you got to have some put options or some bear ETFs to hedge this thing that if it does trade, yeah, you're going to make 5 or 10 times your money. But if it doesn't trade, you might not see that money because of the liquidity factor if the market goes down. So there's a really interesting article, a guy named Paul Singer, right? What he basically created a new hedge fund. It's right here. Because he's scared there's going to be a recession and a big bear market. So he basically raised $5 billion just to he raised $5 billion just to be able to just be able to take advantage of a potential decline in stocks. So he's not trying to short the market. He's not trying to even make money on the market decline. What he's saying is when there's a crash, when the market goes down 30 to 50% again, he's got this $5 billion to go in and buy stocks cheap. So that's when I'm saying, look, the average investor, we obviously don't have access to $5 billion. But if you leave most of your money in cash, a couple small gold stocks, which are cheap, probably won't get hit in a big market decline because they are cheap, that you can turn around and take advantage of these opportunities when they hit. And one of the biggest, most famous, most successful hedge fund managers in the world is doing this right now.
Yeah, but tonight, if you turn on the Fast Money show, they'll talk about Apple and Google and Netflix and Amazon. And those stocks have been the top stocks this year, and they'll probably recommend them because they do every time I see them mention them. So why not just buy those stocks? Why do these hedges and wait out, because you can miss out if they go up for the next couple months.
Here's the problem, right? Because everyone, Kyle Bass has an interesting saying that the average person's memory is probably only 2 years. So they don't want to remember what happened past that. So in 2009, I always tell the story that me and you in March of 2009, we did this conference in the Bahamas. And what was funny is that everyone thinks I'm a perma bear because I've been bearish the last couple of years. I was the most bullish guy at the conference. In 2009, I was saying, hey, I think the market's going to go up for 2 or 3 years. I think that we're sold out. I think the bottom's in. I think everyone's bearish. And no one believed me. And, of course, it went more up than for 3 years. It's gone up for 8 years, And what the problem is with all this is you go look at 2000. Amazon went from 113 to 5. In 2007-8, it went from 101 to 34. So in a bear market, a high beta stock like Amazon, and it looks more like it did in 2000 in terms of the chart and going straight up and blowing off, is going to go down 65 to 90%. And these guys at Fast Money aren't going to tell you that. So again, it's a thing where, you look at Amazon, like you said, to start the year, Amazon was, $700-800. So it's already up 25, 30%. But even if you bought Amazon at 600, and if you don't sell, probably in the next bear market, you are going to lose, 50% of your money in Amazon, even if you bought at 600. So that is just the way these high beta stocks trade, and they blow off. And I think right now, and Mike and I have talked about this like off air, just privately. We're very similar to the 70s. And what happened was in the 70s, the secular bull market topped in 1966. But all these nifty 50 stocks, these big momentum stocks, big growth stocks, IBM was one. There were a whole bunch of them back in the mid 70s. Kirby, like the thing that does this, the carpet cleaner things, right? They were one. There was a whole bunch of them. We call them Nifty 50. There was 50 of them. Xerox was one. These stocks, even though the market secularly peaked in 1966, these stocks all peaked in 1973. So I think that's kind of what's going on now. Even though I think our secular bull market still peaked in 2000, we're 16 years later, but now we're seeing kind of the end of these FANG stocks or these big growth kind of like tech stocks, being Amazon, Apple, Netflix, etc. They're peaking in this bull market, even though the secular bull market, if you do everything adjusted for inflation, probably still peaked in 2000.
Well, what do you? I know you. Both of us own gold mining stocks and junior mining stocks in that area too. What is your take on what's going on there? Because we have had a big pullback since the summer that followed a massive rally, and we've been kind of going sideways here for the past couple of weeks. What's your feeling about what's going on in that sector?
Well, I know some people are turning bearish, but when I look at like the GDXJ, for example, there's a chart here going back. You see the bear market, you see the bottoming, you see the move up. What people don't tend to realize is that these pullbacks in gold stocks can be really bad. They can be 20, 30, sometimes even 40%. And they can last 12 to 18 months before the next wave higher. Like, let me show you what the HUI looked like in the 2000s. You think because the HUI went from 38 to 600, it just went straight up. But no, if we go look at it, I'm going to put this on a log so we can see it a little better. But if we look at it, you can see the HUI here in 2002, when it went to 154, it bounced around for almost a year before it broke out again. And then when it peaked in early 2004, it went sideways to mid 2005 before it broke out again. And even here, you can see in 2001, after the first move higher, there was this consolidation that lasted about 7 or 8 months, and then it moved higher again in 2002. So I just think we're in one of these consolidations. You see the big move here off the lows in 2016 from 101 to 286. And if you go look at it, it looks like we're consolidating like we did in 01 or 02 before the next move higher. And what happens in that consolidation, though, because it is a big drop, it can fall 30, 40, maybe even 50%, because gold stocks are so volatile. It bases there, and then everyone gets disinterested. No one's interested anymore. And then after it goes through that 6, 12, maybe even 18-month consolidation, it blasts off to new highs. And I think we could start seeing it maybe even this summer. Seasonally, gold stocks tend to bottom at the end of June, so we're only a few weeks away from that. And I think this Fed meeting is going to be really key, because I think they will raise interest rates, right, number one. So they'll raise it, number one, but that's number one. But number two, I think that they're going to be more intent on shrinking their balance sheet, which means that after this year, they're really not going to be quick to raise rates. So they want this balance sheet to go down in size. And they're not like selling assets. What they're doing with the balance sheet is they're just not renewing assets, right? They're not buying back the stuff. They're not putting the interest back to work again. So I think that's actually more dovish in a way, which could help gold, because they're raising interest rates at a slower pace.
Well, in that case, I'm looking and there's there's 3 times ETFs for the mining stocks, which are actually extremely popular. Every single day, they're among the top traded ETFs in the entire stock market. And there's one, for instance, Nugget, that went from $15 to well over 100 last year. And there's another one, JNUG, which just did a reverse split on May the 1st. And once it does a reverse split, do you think that, since it just did one recently, do you think that makes it a good time to buy it?
Well, the thing about those, I don't like them because you really need them. You need a bull market, like happened from January to August of last year. And JNUG went from 8 to 130 after the reverse split, right? But now it's only back at 16. You know, like for example, let's say you just bought the GDX, right? If you just bought the GDX, right? You went from 12 to 31 and you're back at 22. You're still almost double of where you were last January at the lows. And JNUG technically had this low at 8, right? But if you go look at it, that was only a few days. You're almost back at the lows now in JNUG. Because it would have been very difficult to buy the exact low, right? So I would prefer that if you're going to buy an ETF, just buy the GDX. You know, just buy like a regular gold ETF. A gold.
Why does JNUG do that?
Because they erode over time. Because it's really simple. If you're going up 2% and down 3%, when that is leveraged 3 times and reset every day, mathematically it just erodes. Like the perfect example is you go look at JNUG, right? And then you go look at Dust, which is kind of the bear version of that, right?
It's collapsed.
Well, that's the thing. JNUG has collapsed from its highs and Dust has collapsed from its highs, because, the gold stocks had this big rally. So if you were in 2-3 times ETFs, like you had $1 in each in 2015, right? Yeah. You'd be losing on both of them right now because these things just erode. So I think the way you're going to have to make money in the gold and precious metals market is you just buy, if you want the big cap stocks, just buy the ETF, the regular ETF, just buy Barrick, just buy Newmont. Or if you really want to be in junior gold miners and trading, actually you can forget trading because this stuff doesn't work unless you're day trading. You buy these little small companies like we're buying in private placements or just on the market. And these companies have assets in the ground. They have production coming online. And they can go up 5, 10, 20-fold when the gold market finally turns around. And the thing about these companies is they're probably just going to sit there right now, right? In the short term, if gold just hangs around 12 to 1,300, they're probably just going to sit there, go nowhere, do nothing. So you just sit on you sit it there on your 5-cent stock, your 10-cent stock. And I'm buying stocks that actually have assets in the ground. They have resources. They have production, right? So you sit there on those and you wait. It's not the most exciting thing in the world to do, but it works when it actually happens. Like, let me give you an example. Way back when gold market started going up, I owned Eldorado, right? And I first bought it in one of my family members' accounts when I was a financial advisor. Right here, in this kind of like $25 to $1 range, right? It's probably at 50 cents or something. And I had to wait for years. It took from like 98 to 2, but look what happened when it took off, right? That's what these smaller producers with increasing production do. They are hyper leveraged to the price of gold. So you might have to wait for this little 20 cent or 50 cent or 10 cent stock right now to move. But when it moves, you're going to be loving it when you actually see this move higher in the gold price.
Well, it's so many people, though, they just want to buy something when they see something that's already gone up for 2 or 3 years. It's really easy to talk someone into buying Facebook or NVDA, but it's very difficult to get that same person to buy one of these junior mining stocks. So what would you say to those type of people?
I would just say that everything is a reflection of price, right? So right now, do you really look at this chart of Facebook? Do you really want to buy this now? Even if it goes to 200, how much money are you risking to make 30%, right? The time to buy Facebook was after it came out as IPO and then it fell and it was $20. That was the time, to buy Facebook.
Snap just came out and it's dropped.
Well, Snap doesn't make any money. It's like more like Twitter, right?
Yeah.
But I would just say it's just a reflection of risk. Like, let me give a perfect example. In 2014, and I'll tell you one of my mistakes. I got no problem admitting my mistake. So I was buying this stock here, Mekl Steel. This is a steel company out of Russia, right? And this company was trading around $1-2, right, in 2014. And now it's, and I think I even started buying it a little higher, like here. It was like, when it was like $3 or something, right? But anyhow, it ultimately went to 84 cents, and then it rebounded $6. So if I just would have held, I would have doubled my money, right? And we go look at Amazon, for example. Amazon in 2014, it was $300-400. It's now $900. You made about the same amount of money. If you bought Mekl at $2, you made 150%. You bought Amazon there, you made about 150% at 400, right? So the thing is, but there's a lot less risk in this because this was cheap. This was a $70 stock. It was going to survive. It wasn't going to go under. Another one I was looking at in 2014 was Natuzzi, which is an Italian company that makes furniture. So same thing. The stock is, $2 at the time. It went to $3. It went down. You could have gone from $1.50 to $3. Again, you made 50 to 100%. And what I'm trying to show people, though, is there's a lot less risk in this because these are companies that are cheap. They're beaten up. How much lower are they really going to go? And you made the same amount of money that you would have made in some of these high flyers without the risk. And what's going to happen to these high flyers? I showed you what happened to Amazon in the last 2 bear markets. People don't want to realize this now, but these companies are going to go down, 80, 90%. And I don't care if you think I'm crazy. Like the biggest one is, and it's totally blowing off, but NVDA, which is now like everyone loves this. And the people will hate me because at 120, I was saying this was blowing off. Now it's 140, and they'll say, oh, it went up another 20%. But look at what NVIDIA has done in past bear markets, right? And now it's even a crazier bubble than we've ever seen in it. In 2002, it went from 22 to 2, and then it went from 36 to 5 in 2008, in the other bear market. And now what's it going to, so each last of the 2 bear markets, this thing went down 80, 90%, So this thing's going to go back to $30, And I don't care what fancy new technologies are in because it's just the law of physics.
Well, I mean, it's one of the most popular stocks for people to buy, though, and trade. And I look at there's something called the Ameritrade Index that shows you the most popular bought and sold stocks with them, for all their customers. And NVIDIA is almost on that list every single month. So, it's so popular, though. How can people stop buying it?
Well, they'll just have a bad quarter. Like one of the stocks that I successfully shorted a few years ago was Skechers. And it's a shoe company. You can see it did the same thing. It just had this huge blow off like NVIDIA is doing now. And then and people say, oh, NVIDIA is in chips and it's got way more going on. So that Skechers is just a shoe company. But you got to remember in mid-2015, I was shorting this for about $50 a share. We were buying puts on it. And everyone was bullish on Skechers. Oh, they had all this growth and they were doing great and blah, blah, blah. And that's what always happens at these top. People reinforce themselves. Like I know someone who's pretty bearish on the stock market, but he really believes in these cryptocurrencies. And he really believes in Bitcoin. And he's trying to give me all the reasons why it's going to keep going higher. And I've just told him, look, man, I turned bullish on Bitcoin a couple years ago after it had that bust in 2014 and 15. But I told him now it's just blowing off again. And when the way that chart is, Bitcoin is going to fall between 60 and 80%. He's giving all these reasons it's not going to happen this time.
Do you know what it's done this week? I haven't looked this week. I saw
Bitcoin's around 2,400. So it's rebounded a bit from the recent lows, but it's not near the highs that it hit a few weeks ago. But all you know is when you see it. When you see a parabolic curve like this, let me show you another stock. This is Bida. This was a Chinese company that sells sells cars. And same thing. You can see this kind of parabolic curve. When you have these parabolic curves, and it doesn't matter if it's a tech company or selling cars online or shoes or Bitcoins, all parabolic curves collapse. Now the problem is you don't know when they're going to collapse. Like I thought when NVIDIA blew off to 120, that was the final blow off. But if it's had one more move here to 144, right? 147 on the intraday high. So the thing is, you just don't know that. The problem with parabolic curves is you don't know when they're going to go down. Like Jim Chanos, who's one of the most famous short sellers of all time, his average short price of Valiant was like 120 or so. It more than doubled on him before it completely collapsed and went completely parabolic. So that's the problem. You just, and of course now if you were short Valiant at 120, you would have been pretty damn happy, right? Because it's down 90% since there, right? But that's the problem with parabolic curves. You don't know when they're going to end. So I don't know if NVIDIA is going to keep blowing off to 200 or Facebook to 200, but I do know they're going parabolic and it's going to end. And so if you're a conservative investor, just be in cash and wait for a time where you can buy things cheap and don't bother chasing. You're not missing anything. Have a drink, have a drink, hang out at the beach, just wait, wait patiently,
Well, when it's summertime, people can do that. They can take a vacation and do things. They don't have to put in a trade every single day. They don't have to turn on CNBC and try to buy NVIDIA or something. They can turn this off and come back later.
Valiant is a classic example because how many people bought this stock at 60 or 100 and then, had gains like 2, 3, 4 fold, right? And thought, oh my God, they're on top of the world. And then almost anyone who bought Valiant in the last 10 years has now lost money, right? So it's just like that's what happens in these bubble stocks, and don't think that it's not going to happen again. Everyone who's bought Amazon in the last 5 years feels like a genius, but if you bought Amazon in the late 90s, even if you bought it anywhere from 30 to 100, you really didn't start making money again till 2009 or 10, for 10 years later. So that's the thing you have to understand about these stocks. And look at Amazon; it's totally blowing off again too. So whatever. It's just look. I'm going to be perfectly honest here. I did not expect this to happen again after 2008, 2009. I thought they might be able to pump the markets for a few years and print money and hold things up, but I did not think we were going to see another bubble. But now we have seen another bubble. And like I said, what can you do about it? If you've got your powder dry, if you can wait, just wait. You're not missing anything. Look at that chart. What's Amazon going to go to? You think it's going to 5,000? Maybe, I don't know. But I think more likely it might go up another $100 or $200 and then completely collapse.
Yeah, but what would you think, though, the argument that, okay, we have had two busts in 2000 and 2008 where the stock market declined quite a lot. In both those times, the Fed raised rates beforehand several times, and let's just say they raised rates too much, and that's why everything blew up. And this time, they've learned from that. Janet Yellen saw what Greenspan did and Bernanke, and she's learned a lot from them. She's talked to them, and they don't want the stock market to fall, and she's really nice and not mean like they were. And then Trump doesn't want the stock market to fall either, so they won't kind of keep raising rates. They might do it one more time, slow down, and they don't want the market to fall, and they've learned, so it won't fall, and it won't do this again, and it's just going to go up forever because they want it to. She's nice to us, not like Greenspan.
Well, if you go look at 99, 2000, they didn't really raise rates a lot. I think they only raised rates 3 or 4 times.
Oh.
And then by the middle of 2000, they got worried about, they stopped raising rates because the tech bubble was bursting. And then by early 2001, I'm sure if I just type in the Fed funds rate, we're going to look at right here. We're going to look at here it is right here, the history of it. There's the chart. And you can see in 2000, they only raised the Fed funds rate from like 5% to about 6.5%. And it was only a few times from 99 to 2000. So I think we're more like doing that right now, not like 2004 to 2006, where they raised it a whole bunch of times from 1% to 5 or 6%. I think we're in this mode because stocks, remember, are actually more overvalued than 2007. So it might take, less rate hikes to actually burst them. So I think we're more like in this mode right now, where they're just going to raise rates a couple times, and at some point, everything will fall apart.
So to wrap up, but just as a conclusion, this is June the 1st. For this month, what are you really looking at in the markets, or do you think it's just a good time to take a break for people and not really try to do much?
I think if you're conservative, like I said, you should be in cash with a couple of beaten up gold stocks because that sector is still cheap. It's still 60, 70% under its all-time highs. Some of the little junior stocks are even cheaper. There's actually good value there. And if you're someone who wants to do things, like I said, in my newsletter, we bought that VJet company. We're up 30, 40% on it. We got a couple other trades. One trade didn't work out. We got stopped out on it. Two of the other trades, one we just entered, and the other one we're up a little bit, like 10%, something like that. So we have these small trades, but if you're going to do that, you have to be hedged. So I have a large hedge position. I'm almost 25 to 30% in either bear ETFs or put options to hedge the other 75%. And if it makes sense, because if let's say the market went down 50%. Now, a lot of those longs I have are gold stocks, but let's just say I was fully long the market, 75%. Well, I would lose like 30%. But these ETFs and put options would probably double, and I'd make 30%. I'd basically break even in a bear market when everyone else has lost half their money. So that's basically my philosophy right now. Cash or some small gold stocks, if you're really conservative. If you want to play, if you want to do some trades, you got to be hedged. You have to have ETFs or put options. I'd say 20 to 30%. Just in case. Here's another thing. We'll go look at this. I was on my eBay page. We're just going to go look at why you should be hedged. Actually, no. Sorry, I'm just looking at 2015. If you go look at that 2015 decline in the summer, what you'll really find is this decline. If you go look at it, 1, 2, 3, it's really most of the decline was in 4 or 5 days. If you look at the 1987 crash, the market really started falling the Wednesday before the crash and fell into Monday of the crash. The crash was on a Monday. So again, that's 4 days. So the reason you kind of have to be hedged is you're not going to know when this decline is going to happen, right? It can happen quick. If it's a crash situation, most of the decline might happen in a handful of days or weeks, right? So that's why I'm saying if you want to be long and you want to play, and if you are someone who wants to own NVDA or Amazon, you got to have your hedges now because you don't know when this is going to end. Is it going to end tomorrow, next month, 3 months from now? Who knows? But when it does end, look at this. Look at the correction in early 2016. Look at the summer of 2015. The corrections are quick and fast. Even if you go back to 2011, you see, boom, this decline here, that only lasted like a week or two. So you kind of got to be hedged going into it, and you can't think that you can time it perfectly.
Well, that's probably a good message for people and a lot for people to think about and to get your.
Oh, and last thing, sorry, Mike. Seasonally, we're in the time, that whole sell in May going away. We're now in the time frame where the markets underperform. From May, June into the fall, the markets tend to underperform, right? And even during this big bull market, if you go look at back every year other than 2013, when the market just went straight up, every year outside of that, the market underperformed from, the summer, spring high into the fall. There was some kind of correction almost the whole year, that either in the summer or in the fall, you could have bought the market lower than it was, in May or June. And this is during a huge bull market move from 2009.
Oh yeah, I mean, even in the best of bull markets, you get pullbacks. We haven't had one really. There was a minor one going into the election, but other than that, we haven't had one in over a year now. So, gotten that they do happen, and it's going to happen again at some point. Well, thanks for taking the time to talk to me and everyone else. And I recommend people go to your website, addictedtoprofits.net, sign up for your premium trading service to get your specific hedging ideas and your long ideas. You mentioned one stock, but I know there's many others that you've got that you're looking at for both sides of the market. So thanks.
Yeah. Thank you very much.
We'll talk with you later.
Thank you.